Another serious warning came out last week about the massive corporate bond and junk bond debt bubble that's still being blown up. So according to this Guardian article that came out on Wednesday, October 16th from Larry Elliott here in Washington, D.C., the International Monetary Fund wrote a warning about the $19 trillion corporate debt time bomb the global economy now faces. So low interest rates are encouraging companies to take on a level of debt that risks becoming a 19 trillion time bomb in the event of another global recession, the International Monetary Fund said. In its half-yearly update on the state of the world's financial markets, the IMF said that almost 40% of the corporate debt in 8 leading countries, the US, China, Japan, Germany, Britain, or the UK, France, Italy, and Spain would be impossible to service if there was a downturn half as serious as that of a decade ago. The IMF noted that the stimulus provided by central banks in both developed and developing countries had the side effect of encouraging firms to borrow more, even though many would have trouble paying it back. That doesn't sound like smart behavior. I added that part. Officials at the Washington-based, but then again, who is thinking long-term anymore? Officials at the Washington-based organization, the IMF, fear that the buildup of debt makes the global financial system highly vulnerable and are telling member states not to repeat the mistake of the early 2000s when warning signs of a possible market meltdown were ignored. I mean, what can they do at this point? The corporations need to pay back the debt themselves. And yet they've done record amounts of share buybacks for the last couple years. The total number of share buybacks that have been done, I think I'll do a separate show on this tomorrow, but I'll just briefly touch on this. I'm also going to play a about 7-minute clip from a speech that Danielle DiMartino Booth gave at a Stansberry conference recently in Las Vegas. It's really, really good, and it talks about the corporate bond and junk bond and leveraged loan markets. So the IMF said share prices in the US and Japan appeared to be overvalued, while the credit spreads in bond markets, the compensation demanded by investors against risk, seemed to be too low given the state of the global economy. So 2 senior IMF officials responsible for the report said, quote, a sharp, sudden tightening in financial conditions could unmask these vulnerabilities and put pressures on asset price valuations. So in a blog post published alongside the article, they also said, quote, corporations in 8 major economies are taking on more debt and their ability to service it is weakening. My friend Daniel Lacalle has called this the zombies. Corporate zombies. There's a lot of them. I can't remember. I think it was the Bank of International Settlement said there's a massive amount of corporate zombies. I think it's 20%. I've covered this and linked to past articles. You can search in the archives of my videos, either Daniel Lacalle interviews in the last couple years or separate videos where I talk about corporate zombies. So just a massive amount of corporate debt, junk bond debt. It's exploded in size. I believe Jeff Gundlach said in the last 15 years, give or take, the size of the corporate bond market has more than doubled. And that is thanks to the central bankers doing financial repression, doing zero interest rate policy. In the European Union and Japan, negative interest rate policy. So the corporations see the interest rates coming down, and the CEOs, the chief financial officers say, hey, we don't have to grow our company normally. We don't have to invest in new products and services. We don't have to spend on research and development. All we have to do to get our bonuses, to get our stock options and all those other perks, all we have to do is just borrow more debt, load the balance sheet with debt, and use financial engineering to grow earnings. And a couple of years from now, 5 or 6 years from now, when the balance sheet's in trouble, we're not even going to be here. We're going to be so freaking rich with our golden parachutes. We're going to be out in 2 years. And the next CEO, like, look what happened with General Electric. So if you want to read the rest of this article, it's here. And now I'm going to play the Danielle DiMartino Booth clip. It's going to be about 7 minutes long. It's really, really good. Yes, I don't agree with her on a lot of other stuff, but this is one of the key insights here where she's amazingly brilliant. Her insights, the stuff that she's tracking in corporate bonds, junk bond debts, leverage loans, her contacts in those different markets is phenomenal. So I talked about General Electric, and really that's when people started to get the warning signals. It wasn't General Electric a couple months ago with the Harry Markopoulos report. It was last year in November 2018, December 2018. And that's when Jerome Powell and the other people at the Federal Reserve, after that last Fed rate hike and the junk bond market froze briefly, That's when the Fed and started to panic. That's when we had the emergency meeting that Steve Mnuchin totally botched after he called the banks and then issued a press release and actually named the plunge protection team in there in the press release. This was Christmas Eve of 2018. If you don't believe me, go and look it up. And all the other alphabet soup agencies, along with the U.S. Treasury and the Federal Reserve, like the FDIC and the other banking regulators, were all called in an emergency meeting then. When the junk bond debt and corporate bonds and GE had problems, and GE was downgraded. So I'll let Danielle DiMartino Booth talk about this, and then I've got a couple more articles. There's a really good, finally, there was an investigative journalist piece on how the ratings agencies, there was a Wall Street Journal piece recently, yesterday, by Gunjan Banerjee and Cesare Pudkol. I think I screwed up your names. I apologize if you're listening to this podcast or someone shares it with them. I apologize if I botched your names. There's a Wall Street Journal article behind a paywall called Bond Ratings Firms Go Easy on Some Heavily Indebted Companies. And there's brilliant investigative journalism into here, naming the specific large corporations where they should have gotten downgrades, a couple of them, and they did not. These are large companies. I will read part of the article. I was able to look at it for free on my phone without paying for the Wall Street Journal subscription. I'm not sure how, but briefly it was up there. I just checked it, so hopefully it doesn't get blocked when I turn my phone back on in like 10 minutes from now and read you part of the article. So I will play the Danielle DiMartino Booth clip right now. It's going to be about 7 minutes long. I think it's important. That's why I'm playing it. It's on her YouTube channel, so she just released it yesterday, and the interview at the end of the show, I will put the link to the full speech, so if you want to listen to the whole thing.
Halloween. October the 31st, 2018. We're going to get down to what we're going to talk about this morning. October the 31st, 2018, Halloween Day, Moody's came out with a second downgrade of General Electric's bonds. Overnight, the bonds traded into junk bond territory. By November the 14th, junk bond issuance in the United States went into a deep freeze. The Bank of International Settlement, the World Trade Organization, every international entity, regulatory entity in the world was scared stiff because we have this thing called the Exchange Traded Fund, backed by bonds that during that 41-day record freeze out of no issuance, traded by appointment only. Collateral is not supposed to work that way with a security that has instantaneous. You can trade it all day long and every day, and yet the underlying collateral behind it was not trading at all. And so, on January the 4th, I didn't know that I needed my box of tissues, but I did. Jay Powell, Ben Bernanke, Janet Yellen. By the end of the speech, which we now know as the Powell pivot, Powell had apologized for his 2012 remarks that were a matter of public record in the FOMC transcripts, wherein he said QE could become habit-forming, and this concerned him, and he was adamantly opposed to quantitative easing. And he was the individual on that committee after Yellen left who was the most committed to shrinking the balance sheet, to normalizing monetary policy, to unwinding this grand experiment. On January the 4th, Jay Powell had to step back, and I had to disband my fan club. And I took more you-know-what on Twitter than I can possibly describe. The I told you so's have not yet stopped coming. My point is, there is nothing for you to watch on a day-to-day basis in the stock market that is going to faze Jay Powell. He still doesn't care what the stock market does. But he does care what supports the stock market. And what supports the stock market is the bond market. There are all kinds of charts running around out there that show that over the last X number of years, if you add up every pension fund, private pension, mutual fund, exchange-traded fund, individual investor, add up every single type of stock buyer in the world, net negative purchases, as in selling. What's kept the entire stock market held up for years? Anybody? Thank you. Buybacks. If a CFO has to pay attention to their balance sheet, what is the one thing that they're precluded from doing? It's a hint, same answer. Buybacks. So, here is the investment grade. So we're looking at the pristine, you can sleep at night, safe corporate paper. As you can see, interest coverage at 10.1. This is fresh data from Morgan Stanley. That is at the lowest level since 2010. Cash to debt at 13.1% takes us back to the days prior to the last recession. Corporate balance sheets. This is a $7.5 trillion market you're looking at, are in a tatters. And this is with interest rates at last check. If you combine Japan and Europe and their negative interest rates with ours, I think we're still at 5,000-year lows. I'm not going to fact check Merrill Lynch's math. Interest rates are still really low. You would not expect to see deteriorating fundamentals in corporate America, led by triple B bonds. Quick show of hands once more. Triple B bonds are on your radar screen. You've read about them. Oh, good, fresh meat. Very few. Okay. Credit rating agencies have ladders. Right before you cross the Rubicon into junk bond territory, there lies triple B. You may recall that credit rating agencies were strong-armed, shall we say, to maintain AAA ratings on subprime mortgages back in the day. But the good news is they've figured out the error of their ways and they now behave. No, that's actually a lie. The line today is held between triple B and junk. Morgan Stanley did a bit of nifty math and found that if the credit rating agencies were actually doing proper due diligence, that 39% of the investment grade universe would be in junk bond land. We're not talking about a small dollar figure here, 39%. This is what keeps Jay Powell up at night. So let's add it all up. Non-financial corporate debt in the United States is $15.5 trillion, 74% of GDP, a record. We've never seen non-financial debt anywhere near these levels. And so here we have the triple B universe, which we just talked about, is only $3 trillion of it. Bonds rated north of that rating are $2.5 trillion. Go down the credit stack, you get to $1.2 trillion in plain vanilla junk bonds, the ones we used to think of. There's a story right now out on the Bloomberg terminal about the next category, leveraged loans, $1.3 trillion, and losing money fast. A buddy of mine who used to work at a big credit rating agency, she was the head of high yield for a long time. She quit in protest because she refused to hold the line on that junk bond rating. Years ago, 10 years ago, she said, Danielle, this is all you ever need to know about leveraged loans. If a company can't access the junk bond market, that's fine. They just go and get a leveraged loan. So think about them like that. And then a little bit riskier than that is an almost $1 trillion private debt market. But know this, very little of what we think of as being investment grade, $2.5 trillion, very little is truly investment grade. So be careful with what's in your portfolios.
Okay, so she warned about the ratings agencies. Notice how she was talking about the more strict leverage ratios I was talking about, where like debt to cash flow and some of the others. She did not talk about EBITDA or EBITDA coverage ratios, which are the extremely lax stuff, the stuff that a lot of corporations put out there. The EBITDA or EBITDA ratios are just, it's so laxed. If you use the more strict ratios, a lot of these large corporations are in deep, deep trouble, like debt to equity, debt to cash flow, debt to free cash flow. These corporations are in trouble. The ratings agencies have bent over backwards through pressure and financial incentives and there's a handful of reasons why. And I've confirmed through other sources that it's not just in the US, it's also Hong Kong listed companies, where the Hong Kong listed companies are not being downgraded below triple B. So it's pervasive in the US. That Danielle DiMartino Booth has confirmed this with her sources. She's talked about this many times. I confirmed it with a source from Hong Kong at the S&P, one of the ratings agencies firms over there. And also the Wall Street Journal did a story on this yesterday, and it's a very good story. Let me pull it up here on my phone. Hopefully it will work. It's from yesterday. Like I said, bond ratings firms go easy on this is being polite, heavily indebted companies, Kraft Heinz, Newell brands, among big consumer companies given time to get their leverage down. In August, bond ratings firms Moody's and S&P Global predicted that Newell brands would soon reduce its heavy debt load, allowing it to keep its coveted investment-grade bond rating. They made the same prediction in 2018. And in 2017, and in 2016, and in 2015, and when, I can't believe I'm reading this, and in 2015 when the company announced a big merger that quadrupled its debt. So, wow, the company has been given over 4 more years, plus a heavily LBO or leveraged buyout, where it quadrupled its debt to lower its leverage ratios, and they have not done that. And the ratings agency still did not downgrade. Yet bond ratings for the maker of Rubbermaid containers and Sharpie markers haven't budged. So they still weren't downgraded. When S&P and Moody's made their upbeat projections in 2018, they made an error that understated Newell's indebtedness, according to a Wall Street Journal review of the rating firm's calculations. So this is doing finally some real investigative journalism here, calling out the ratings agencies, someone in the mainstream financial media. Thank you. Amen. Preach, preach. They have since fixed their numbers, but still rate Newell as investment grade. So they corrected the numbers, but did not downgrade them anyway. Investors have been less forgiving, selling off the bonds and driving up their yield. Moody's and S&P didn't dispute revising their calculations, but said the changes didn't affect their ratings. Yeah, because they're probably getting some type of other business from the corporation, maybe some type of other kickback or something along those lines, some type of other business where they're incentivized to not downgrade their credit rating. Also, from what I've heard from another source at a whistleblower inside one of the credit ratings agencies who sent me documents, that there's enormous pressure not to downgrade as well. Amid an epic corporate borrowing spree, ratings firms have given leeway to other big borrowers like Kraft Heinz and Campbell Soup, allowing their balance sheets to swell. Campbell Soup is one of the worst ones I've seen. There is little or no, there is revenue, the revenue is flat or contracting for the last 4 or 5 years. They have a 64 times price to earnings ratio, which is essentially a growth stock, and their debt to equity ratios and debt to cash flow ratios are way, way, way out of whack, especially debt to equity. I believe the last time I looked at Campbell Soup, it was 3.5 times as much debt as there is to equity. So that means that all the assets, and I'm using air quotes, that Campbell Soup is holding, because their brands are being, if you go to the grocery store and you see how little people shop in the Campbell Soup aisle, their assets in air quotes are all held with massive amounts of leverage. Quote, it's pretty eye-popping if you've been doing this for 20 plus years to see how much more leverage a number of these companies can incur with the same credit rating. Greg Haendel, a portfolio manager at Tortoise in Los Angeles, overseeing about $1 billion in corporate bonds, said, quote, there's definitely some ratings inflation. He's being too kind. Years of rock-bottom interest rates have fueled a boom in borrowing, driving debt owed by U.S. companies, excluding banks and other financial institutions, to nearly $10 trillion, up about 60% from pre-2008 financial crisis levels. Leverage, how much debt a company owes relative to its earnings, hit a high in the second quarter of this year, according to J.P. Morgan Chase & Company on investment-grade bonds going back to 2004, which also excludes financial companies. The buildup has fueled one of the most divisive debates on Wall Street. Will higher debt loads cause big losses when the economy turns, or have low interest rates made the borrowing more manageable? I would say it depends on what the borrowing was used for, but most of these companies did bad acquisitions where the cash flows did not increase overall, And then they did a bunch of share buybacks, which was only based on short term to financially engineer higher earnings. And the management teams were not thinking long term about creating more shareholder value. They were thinking about how can we get rich quick in a couple years, get out, get a golden parachute, make many, many millions of dollars extra for ourselves, and who cares what happens 5-10 years from now. And that's why General Electric and some of these other large corporations, General Electric appears to be the first one, are in such big messes. Yes, I'm glad you love the cartoon 782. That is the low interest rate party bus. I found that right before I went on. I thought that one was perfect. The low interest rate party bus. So if you want to read more of that article there too, there's another, I'll attach links to that in the information and description section. The other warning that came out today was, I believe Morgan Stanley is now warning about the leveraged credit market as well. So the fact that the leveraged loan market has been so remarkably stable, despite the occasional high-profile blow-up in a time of relentless redemptions from loan funds, which have seen weekly outflows for nearly one full year, resulting in 22 billion outflows year-to-date. And then Morgan Stanley writes in a report over the weekend, the cracks in leveraged credit markets are expanding and becoming more apparent. So if you want to read more about that, I've been warning about CLOs, collateralized loan obligations. So has the Bank of International Settlements in their quarterly update from September in a research report that you can download for free. And so has the Federal Reserve in a research report in July about CLOs, how big of a problem they are. And also today, Bloomberg had an article that now JP Morgan Bank is worried about the money market funds. And why would JP Morgan be worried about the money market funds? Because, and this is on Bank of New York Mellon's own website, they are the custodian for a lot of the repo market. They have been taking a lot of money market money and then loading it, doing a swap trade with treasuries and capital from money markets with hedge funds, and helping and leveraging up that and increasing the amount of those types of repos, with hedge funds as one counterparty and money market funds as the other with leverage. And the middleman is Bank of New York Mellon. And that part of the repo market, since I think Bank of New York Mellon took that over in about 2.5-3 years ago, it has gone up massively in size. It was, the size of that market was almost near zero. And they've built that market up to around $100 billion per month. So Bank of New York Mellon making a lot of money for themselves, but also adding a massive amount of risk and adding a lot of risk to the money market funds. Because now those guys, in order to get a higher return, in order to get more yield, because central banks are doing financial repression, because they're in the past, money markets, you could get a more reliable return in the past. But now what central banks have done is they've lowered interest rates so much through manipulation. So in order to get any yield, now money market funds are gambling like crazy with leverage in the repo market too. Oh yeah, the auto, I may do a separate show on the auto companies. There's a lot of signals that whether it's the used car market and others, that the U.S. auto market is in big, big trouble. I may do a separate show on that. Yep, it's the low interest rate party bus, but we're not on it here on Main Street because we don't get low interest rates. So if we want to borrow with a credit card or something else, we don't get low interest rates. So the low interest rate party bus is only for the large corporations, the large Wall Street banks, overly indebted governments. Thank you for the super chat, Pubble Man. I appreciate it. If you can't see the rest of the economic cartoon, the low interest rate party bus is about to go off a cliff. And the front tires there are hitting an oil skid. Now, in that picture, that oil barrel is an OPEC barrel, but it should be a shale oil barrel because the shale oil barrel should be going over the cliff with the low interest rate party bus. The shale oil guys should be in the low interest rate party bus and they should be going over the cliff. You should have some Silicon Valley unicorns in there too. So there should be in the low interest rate party bus, there should be some shale oil tycoons and some Silicon Valley unicorns, and they should be all ready to go off the cliff. Oh, Nancy says, very important information. Thank you for sharing. You're welcome, Nancy. So there's a lot of warnings coming out. The corporate bond market is already too big. The junk bond market is already too big. The leveraged loan market is already too big. The collateralized loan obligation market is already too big, and they're still growing. And now the banks are doing crazy amounts of mortgage-backed securities again. They're starting to roll things out. Will mortgage rates go down? Maybe. Maybe. There's a lot of people who think that they will try to continue to inflate the housing bubble. The problem with lowering mortgage rates is that, from what I'm hearing, this is from Danielle DiMartino Booth and others, is that the amount of people applying for mortgage refinancing has increased 170% in the last year or two. So there's a massive increase in people applying for mortgage refinancings. The problem is that a much smaller percentage is actually being approved. Koisi says, zombie companies that eat cheap money. Yes, instead of brains. And yet we hear all these Keynesians, and I totally disagree with this. There's all these PhD economists that are making 6 or 7 figures on Wall Street and hedge funds and consulting firms, either from hedge funds or investment banks or government economists, saying that there's a global savings glut. And it's just ridiculous. I mean, the debt levels in society here in the United States, European Union, China, it's increased massively. So they're claiming there's a global savings glut. I really don't see any evidence of that. China does still have some reserves, but most Chinese citizens don't have savings anymore. There's tons of articles coming out just in the last couple months about how much debt in Chinese society there is now, especially younger adults. No, I don't think that's Janet Yellen. No, that's Larry Fink from BlackRock with the ETFs and high yield ETFs. Most of the people holding up junk bond, high yield, and ETF signs. This savings glut goes back to Keynesian theory, which is paradox of thrift. There's always a liquidity trap. It all goes back to the BS Keynesian theory. Because Keynes used to say that paradox of thrift, and that if people save, it's bad for the economy. Because people are not spending. And Keynesians always find a liquidity trap. So when you hear that these hedge fund people are saying that there's a global savings glut, I don't believe it. I don't think it's true. And yes, there's a lot of people on Wall Street and a lot of hedge fund people and a lot of government economists and a lot of investment bankers who believe there is a global savings glut. Because they all learn Keynesian economics and they got an A or a B in their college economics class. And I know there's PhD economists listening anonymously to this podcast who think everything I say is wrong and that all their schooling is right, but it's your damn fault, a large part of it, why we're in this mess. PhD economists deserve an enormous amount of the blame for why we're in this mess that we're in the last 10, 15, 20 years. Social Security is a tax, Diana. Social Security is a tax. The government spent a lot of the money. It's IOUs. The government takes the money immediately. It's taxed and it's an IOU. And then they put treasuries into the Social Security fund, if I remember correctly. That's how it works. Social Security is not running massive budget surpluses. They're not like a sovereign wealth fund. They don't have trillions and trillions, and they're not setting up private equity and venture capital. They're not doing all those things. Okay, I'm looking at listener questions and comments. I'm going to get out of here in a little bit, though. Douglas says the total liabilities of just Ford and General Electric are close to $500 billion. You must be kidding. And then General Electric loaded, in the last 10 years, they changed the employee pension fund and loaded General Electric stock into there. And that was a big red flag because there was no diversification in employees' pension funds. And now they're going after employees' pension funds too. 20,000 plus employees. Big red flag for these large corporations that have way too much of the owned company stock in their employee pension funds. Big, big red flag. House Portland says nothing is fully funded. I 100% agree. No one's thinking long-term properly. No one is properly thinking long-term. So many policy decisions, so many decisions by large corporations are all very myopic, very short-term oriented. Yeah, if you like the video, please hit a thumbs up. It's much appreciated. I appreciate it, Haster. I want to thank everyone for listening to this podcast. Almost 200 Patreon account contributors. It's over 170 now. It's growing very rapidly still. A dozen monthly PayPal account contributors per month. And thank you very much to the people who chip in once in a while. It's much appreciated. I work very hard creating unique content. You will not find it on other channels where I can play a clip like that for 5 minutes and analyze it and talk about the ratings agencies and where all the pieces to the puzzle fit. And props to the journalists at the Wall Street Journal who finally did an article, finally some real journalism for once, exposing the stuff, the shenanigans that the ratings agencies are doing. Finally. It's only a couple years too late, but finally, at least someone did some work here. Okay, well, that's it for right now. I'm going to keep cranking out unique content for everyone. Hopefully my channel will be over 30,000 YouTube channel subscribers in a little bit if YouTube doesn't totally ruin me financially or stop the channel from growing, which they've done in the last 5 or 6 weeks. And if you're interested in signing up for my Patreon, I do have behind the paywall there is a 9-page in-depth Sandstorm Gold article about why I think the company has a very bright future in the next 2 years that basically all the article writers on Seeking Alpha don't understand. There's one Adrian Hernandez, my friend, that I talked to, and I think he gets it, but pretty much all the other ones have no clue. It's pretty bad. Okay, well, that's it for right now. Thank you, everyone, for your time, and I'm going to keep working, making the most original, thought-provoking content about investing in the economy on YouTube.